Welcome to the Broken Pie Chart Podcast, episode 71. I'm your host, Derek Moore, and today we have an extra special guest, or any guest is special, and that's William Rhind, the CEO of Graniteshares. William, or Will, how you doing today?
I'm very well. Thank you, Derek, and thank you so much for having me today.
Of course, yeah. No, I'm looking forward to the discussion, and there's a lot to get to. And I think I saw in your bio, you're actually a pretty big, we'll call it European football, but for those who we may confuse, a soccer fan, right? Do you have a favorite team?
I do, yes. I'm a big fan. I'm a big Manchester United fan. And so it's kind of funny because literally the first week of March, I was in Manchester watching Man United play in a European Cup game. And obviously, just before kind of probably one of the last games before everything shut down. So I was very lucky to do that. I hadn't been there for a while, but I was over there and strange to look back on my phone and see the pictures of and the videos, obviously, of that game, based upon what we've just gone through over the last sort of couple of months.
It is kind of amazing, and I know the German leagues opened up, and I played. I'll refer to it as soccer, but yeah, I played football in high school, but that's going on. God, I don't know how many years ago that was. So I've always followed it, and it's interesting because I live not on the West Coast, but I live in Arizona, and so the games come on here, the Premier League or the Bundesliga, 6, 7 in the morning, but I've got a 9-year-old and of course, and a dog. So between the dog and the 9-year-old, they're going to wake me up early. And it's just really nice. You grab a cup of coffee, a little breakfast, and before you know it, you watch a match. So I've followed it, and I like the relegation and promotion aspect. I think when you look at incentives, like in economics, you think about incentives. In the NBA, you're almost better off just trying to lose. But there's a real penalty if you don't do well. I mean, you might go to the second division and never get back up, right?
Yeah, I mean, it's a very interesting system, when you explain it to Americans and contrast it with, the NFL and other leagues, because in many ways, I think it's sort of counter to what people might think, in that in Europe, you have a ruthlessly capitalistic system, if you want to look at it like that. Which would be not probably the first thing you'd think of when you use the word Europe. And then in the US, you have something that is, very much, socialist in terms of a league like the NFL, where the owners control the league, and you can't. Once you're in, you're in. You don't go out. Whereas obviously in the UK, on the soccer leagues, if you perform badly, you're out. You get replaced by someone who's done better.
Yeah, no, I kind of like the system, but it's anyway. We this is probably we're going to talk about investing and portfolio management. We could probably go on for hours, but no, it is interesting. And think about the relegation and promotion. It's I know I was going to talk to you about the idea of good companies, bad companies, companies they're more likely to grow, and it's one of the strategies that you run. One of your ETFs, X out, right? It's almost like a promotion relegation strategy, right? I mean, you're promoting, you're relegating companies, right, in that fund.
That's exactly right. It's a very new take on investing, kind of more broadly. So I'd say, think of it like this: that technological disruption, we think, is probably one of the largest forward-facing risks faced by all investors. So the question is what to do about it. And as we know, there are kind of broadly speaking two kind of schools of thoughts in the investment world, which is on the one hand, it's the school of picking winners, and that's largely speaking traditional active management. And that's the idea that, by picking the right companies, by identifying the winning companies, you can outperform the market. And of course, as we all know, that's incredibly difficult to do. And the vast majority of active managers don't outperform the market, over time. And so that kind of led to the other church, which I'm kind of a part of, which is the index and ETF community, which a lot of investors, say, well, we can't beat the market, then we'll just own it. And there's obviously long discussion about what that actually means. But what it means is you're accepting guaranteed underperformance when you factor in fees and taxes. And so what X out does is sort of flips it, both of those things on its head and says, well, actually, is there a way to do this better? And actually, if we identify companies that are bad companies or companies that are vulnerable to technological disruption, if we X out those companies, can we actually outperform by excluding losers as opposed to picking winners? And in some respects, you flip it to, is it actually more important what you leave out of your portfolio than what you put in? And that's really the framework that that we go by with X out.
I think it's interesting, and I want to get to some of the companies that maybe you exclude, because I think that's interesting as well. But there's this whole push and pull between value stocks and growth stocks, and it's but then you look back, and sometimes you could be right about what's going to happen. I always think about it. You could have predicted that everyone's going to have a cell phone in 20 or 30 years, and you might have put all your money into Nokia, and that turned out to be the wrong bet, or Netflix versus Blockbuster.
Mm-hmm.
And there was always that friction, right? With the friction was you didn't want to get in your car and go to the Blockbuster, and so you wound up paying late fees. But that it's sort of interesting to think about where technology is going, and some companies that adapted, or I just think it's this interesting dichotomy between the two.
Yeah, and I think that it's I don't want to it's always dangerous to oversimplify things, but I think sometimes it can be instructive. And so in some respect, what we're talking about here is that, every company that wishes to remain a going concern must become a tech company. And I know that's obviously ridiculously oversimplified, but in some respect, I think it helps to kind of frame this discussion in that lens.
It's kind of funny. You think about, and I always bring up Dominos and Google because they IPO'd, I think it was months apart in 2004. And I checked before, we went on air today. And in February, somebody did an article, and Dominos has returned like 5,600 cumulative %, and Google's, somewhere like 3,500. I could be off on the math. But there are some people who would say, Domino's, they're a store and they make pizza. But they're really more a logistics company, and they've got the app, and it's certainly not the best pizza. And growing up in the New York area, that would never be my first choice. But Are they a technology company? Like, is that the example?
Well, I think it's certainly one of the examples, and it's a great point because, as you just rightly pointed out, they just went into the S&P 500 fairly recently. But it's about this is about companies that can adapt to this digital age, and companies that have a digital strategy. So in that sort of vein, I mean, think about all the ways that pizza can be technologized. So you have digital marketing, ads obviously that go with that, the gamification of points, rewards, micro-targeting of existing customers. And so in many ways, by mobilizing social media for a restaurant, ultimately, you get a broad expansion of the customer base, and you can turn those sort of traditional storefronts, if you will, into Amazon-style fulfillment centers. And I think in terms of the restaurant, it's a great example of how something that people would identify as a fundamentally traditional business can adapt and change, and can really massively sort of scale its game by adopting a digital strategy. And so when you think about the way that some of these companies are repositioning, and I think Domino's is a good example of that, you think about the pizza, it's less about being a pizza restaurant or traditional serving customers in a restaurant, much more about pizza delivery on the internet.
I look back at a company that's certainly not around anymore. You might remember, what was it, the pets.com. And before people think, well, isn't that the pet store that I order from? That domain was bought at bankruptcy. But, in 99, pets.com IPOs, and I think 9 months later. But back then, no cloud computing. I mean, the distribution was different. There are any number of reasons why people say, how does it work now versus back then? And that's, I don't want to do a whole session on pets.com. I think plenty of people have done that. But it is sort of interesting to think like why that worked back then, and how technology changes what really is just it's a pet store, right?
Yeah, exactly. But I think, again, it goes to the sort of the mindset. And what we're talking about here is a mindset change. And the current mindset would be, well, is pets.com a buy or a sell? Or is Google a buy or a sell? Is Domino's a buy or a sell? And what we're trying to do is to say, the vast majority of performance that generates in a major stock market index, so stock market index returns, we know that the vast majority of those returns come from only a handful of companies. So people own those companies anyway, and we all know, roughly speaking, who those companies are. And so really the way to add value is actually just screen out the companies that are detracting from that performance, and spend much less time thinking about who's going to be the next Google or who's going to be the next Zoom, or whatever it may be, because that is incredibly difficult to do. We don't know who those companies are going to be, but we know who are the companies that are most likely to underperform.
What are some of the attributes that is it free cash flow growing? Is it net margins? Are there any sort of just high level tells if you covered up the name of a company, you just looked at some of the numbers on either quantitative or fundamental basis? Some things that sort of, hey, I don't know which one is it going to be Nokia? Is it going to be Apple? But I know when I see this, it's sort of interesting to me.
Yeah, I mean, absolutely, and that I think is one of the things that I think is kind of compelling about the approach is that first of all, what X out is it's an index strategy. So just to be clear, this is not me or any of my team kind of throwing darts at a dartboard in terms of picking companies that we personally think are not likely to make it or are zombies, etc. No, this is a rigorous fundamental process where it's entirely rules-based. So we look at 7 fundamental factors, and we score the 500 largest companies in the US by market cap, and we score them 1 to 5. So 5 being highest score, 1 being the lowest score, and we eliminate actually the 250. So we eliminate half with the lowest scores. So when you think about the types of fundamental metrics that we use, I think people, when they listen to this, I would hope people would think, well, that sort of makes sense. And in many ways, it's what a lot of active managers would use to try and identify good companies. But here we're using it to flip the paradigm and identify companies that are not going to make it. So, for example, one criteria would be revenue. So can a company increase its sales or not? Employee growth, is it firing or hiring people? R&D investment, is a company investing in itself or is it refusing to invest in itself? Stock buybacks, is it respecting its shareholders, and how are those buybacks being done? Are they done out of free cash flow, or is the company having to borrow money to do that? Profitability, can a company make money or not? Or earnings forecast, is it expected to make money? And then we have a management score as well, in terms of is the company outperforming or underperforming from a management perspective. But I think those are all, in my mind, they're sensible fundamental metrics. But blended together, they create a sort of compelling picture of companies that are not doing well.
And just taking a look at one that gets excluded, and I don't know if anyone has asked you about this one. The nice thing is, okay, well, look at Walmart, right? So Walmart is one that you exclude, and look. Someone who doesn't do, we manage portfolios that are really broad and we hedge and we use so I'm not doing individual stock picking, but I looked at Walmart and I said, okay, it was just sort of interesting when I looked back. I think I went back to 2005 and, their PE has expanded. Their share count is down. Their net income has been lower. Net margins have lowered, although they were never a high margin business. And really, their play now, I think, what is it? They bought Jet, and they want to, probably the bull case for them is they figure out how to. But I just thought it was interesting. Walmart. Most people would think, well, wait a second, they're Walmart, right?
That is one which, that's our largest X out at the moment. So that means by market cap, that's the largest, our largest stock that we eliminate that would be in our broad sort of universe. And again, I think this is the great thing about the approach is that it just takes the emotion out of it. And You don't have to get into these sort of discussions about the things that Walmart's doing well and the things that Walmart's doing not so well. I mean, I'd point to a few things. So, one, since Walmart became the top X out in our index, the market's up, almost 10%, while Walmart's down 7%. And I think the probably the biggest factor for people to take away in terms of our model is that they just haven't been able to grow faster than the rate of inflation for years. And so they haven't been able to innovate effectively, meaning that the digital strategies that they've tried to employ, and you just briefly mentioned Jet.com, which they actually exited, announced actually over the last sort of couple of weeks, but it hasn't been able to move the needle in a way that would really impact the stock. And so from our model perspective, these sort of things like acquisitions of Jet.com and Flipkart, all these things which on the one hand, a non sort of rules-based investor might look at and say, well, these are positive things. But from our perspective, the intractable problem is that it can't grow revenues at the pace of inflation. So on a real basis, the sales are actually going backwards. And so for Walmart, if you're already selling $500 billion a year worth of goods, how do you sell an extra 30 billion? And that's the question that they so fundamentally haven't been able to answer. And so, really when you think about Walmart, just think of a company that has just such big size that it just becomes very difficult to move the needle for them in terms of growth. And that's kind of the big problem.
Yeah, no, it's interesting. And you mentioned real versus nominal. I just looked at the nominal numbers, and it was, obviously, and I may ask you about, dividends versus buybacks just in general, but it was interesting to look and see, just the net income, I think the sales, if you look 10 years ago, I could be wrong, but I think the net income is lower than it was. And I don't want to make this all about Walmart, but it's almost like, as a sports fan.
Yeah, I mean, if you think of the contrast, so one of our top holdings by contrast is Amazon, and again, we don't want to go on about Amazon as how good a business that is, but the point is, I think if you do the juxtaposition and you say, fundamentally the strategy is long Amazon and short Walmart, that's kind of long digital, short physical in terms of the way that those companies are positioned, and I think most people would agree. And again, this is not a qualitative thing, but that Amazon is probably the better positioned company for the digital age.
With regards to buybacks and dividends, and I always look at it, it's a return of capital. It's a return of cash to investors. And the nice thing about buybacks, it gives the CEOs more flexibility. Certainly if a CEO said our dividend's going to be $2, then $4, then $1, one, the analysts wouldn't know what the heck to do with them, but the stock would probably get punished, right? And then how would you, if you're some, tried and true fundamental intrinsic value person, how would you even? But I mean, I think there's this debate, and really it is a return of capital. But I think you have a little nuance to that, right? Regards to buybacks.
Well, I think our take on it is, fundamentally, I think most people would agree that buybacks are a good thing from a shareholder perspective. However, our twist on it is, and again, this comes into the whole concept of zombie companies and the interest rate paradigm that we're currently in. But we think that there's a difference between a buyback, which is done out of free cash flow, and a buyback that's done through borrowed money. And in other words, the free cash flow one is much better from our perspective than if you're borrowing money to buy back stocks. And I think, we can talk about that, like I said, in the context of zombies, but kind of shuffling around borrowed money, I don't think is particularly helpful or instructive. And so we like companies that do that out of free cash flow.
Yeah, no, and I definitely want to get to zombies and inflation. And before we go there, I just thought it was interesting that, the whole value versus growth, and they're the Buffett crowd, and they're like, hey, there are really cheap companies, and the contrary argument would be they're cheap for a reason. But I do think some, like in March of 2099, none of those tech stocks ever lived up to their value. And again, I just look back, 14 years or so. Why 14? Because that's when I pulled up, right? And you could have bought, I think it was Apple at basically one time forward 14-year, net income, right? And I think you could have bought 1.5 times. In other words, the market cap of Amazon and Apple, then you look at 14 years later, you were buying out of a forward 14 PE of something like 1 to 1.5. They've lived up to their value, and in some ways, maybe they were value stocks all along. I just think it's interesting when you get into the value versus growth.
Yeah, I think that this is a massive topic, and again, we could do a whole series of podcasts on this because I think this is like an existential question for the investor today, which is, is value even relevant, or is value dead? Does it even exist anymore? And I think, I guess let's kind of start from the beginning. So, what is value investing, or what is a value stock? Well, I guess that the common probably definition would be a value company would be a good business, in air quotes, that's trading below its fair value. So therefore, we have to ask ourselves, what's a good business? And again, coming back to the X out parlance, what we're trying to do is identify what we think are not good businesses and exclude them. But again, go back to value. So a good business, it's one defined that is a company that's trading at a low price relative to its assets, its earnings, or its cash flows. Often found in unfashionable industries or growing slower than other companies in the market. And so if you look at something like the Russell 3000 value index, which in some respects is the kind of bellwether of value in terms of the larger spread of value companies, you see that the biggest sectors in that index are financials, healthcare, utilities. Now, I think healthcare, clearly there's a difference between again, companies that are adopting technology and healthcare tech, and sort of legacy healthcare companies. Financials, utilities, similar, but ultimately, are those really the sectors you want to own? And I think some things I just thought that would be worth kind of mentioning, and things that we think about in terms of this argument on value, which is, when you look at traditional value, in the past, one of the things that the value investor would look most at is its physical assets. So property, plants, equipment made up the bulk of a company's value. But today, that's changed massively. And, in today's market, you've got intangible assets, so non-physical assets, such as IP, patents, trademarks, brand, data, software. They've become a much bigger part of a company's value. So, interestingly enough, there's a survey that, for example, in 1975, in terms of the S&P 500, 85% of companies in the S&P, the value of those stocks, 85% of the value was in tangible assets. Now today, that's around 15%. So that number has fallen. It's almost flipped completely on its head. So the vast majority of value ascribed to companies in the market today is actually intangibles, and that's not a traditional value metric. So value, you can argue, is just the wrong frame of reference today for companies. And look at I just thought I'd mention it because obviously we're living the COVID lockdown at the moment, at least obviously here in New York, where I'm speaking to you today from. But Zoom, everybody's been on a Zoom call, I'm sure. That was a company that IPO'd just over a year ago at a valuation of $10 billion. That company's now worth $50 billion. So that's more than the entire US airline industry. And I just think that there are these kind of fundamental shifts that are occurring in the economy, which, regardless of sort of how you label it, I think is changing things really forever. And the concept or the frame of reference to me in terms of traditional value, I think, is gone. I mean, look at the most famous value investors in the world. They haven't been able to outperform, and they keep sort of waiting for it to come back in favor. And we all know, who those people are, but it just hasn't worked.
And I think, you mentioned what we're currently going through, and it's whether you think about online education or the Zoom model. And by the way, how did Microsoft or Google not we could go off the rails here, but like
Yeah.
they created no friction, and all of a sudden, Google and Microsoft can do what they do anyway. But no, I think this current crisis has sort of fast forwarded a lot of the trends that were going to happen anyway. And you look at J.C. Penney, which I pulled up their interest coverage ratio, which is of course their income over their debt payments, and I think it was 0.2. Like you're not even making enough to pay the debt service. But I think the zombies. This crisis has sort of fast forwarded that quite rapidly.
Yeah, I mean, in 1964, the average tenure of a company in the S&P 500 was 33 years. I mean, think about that for a second. So 33 years, most investors, that would be their career. You would have a company that would still be in the major market index for their entire career, never change. And then in 2016, that tenure dropped to 24 years, and now is expected to drop to under 10 years in the next decade. So what's going on here? Well, what's going on is technological disruption, and that it's just happening at a pace which is difficult for the market to factor in. I mean, exponential growth is just something that the human brain finds impossible really to compute. And so that's meaning that there are these seismic shifts going on that are just very, very difficult for the market to price in. So from our perspective, again, it's just so difficult to pick those winners and really identify, who's going to be the winner. As you rightly pointed out, certainly Amazon, Google, Microsoft, they all have their own kind of versions of Zoom, and certainly Microsoft and Google, the main. But who would have thought that Zoom would be the one that would sort of capture the imagination? Just very, very difficult to predict.
Yeah, it's a great point. And you talk about shifts and paradigm shifts. I want to transition to interest rates a little bit and maybe your view. And when I wrote my book, and the Bank of England was nice enough to have something like, interest rates back to the 1600s that I was able to download. And you look at that, long of a time frame, really interest rates were sort of, call it 4 to 6% for many years. You had the 1970s, which really is the outlier with, the fact that you could have bought a 30-year U.S. Treasury at a 15% yield. If I wrote the book back then, I would have had one page, buy a U.S. Treasury for 30 years, and I'll write the rewrite in 30 years. But, lower for longer and negative rates, I think we're starting to see a lot of people who said, look, this can't last. We're going to get inflation. I don't know where you sit on lower for longer and just, interest rates in general.
I think, unfortunately, the question's kind of been answered. And that is, first of all, the Japanese have been doing this for decades. And so the idea that you can only have low interest rates for a short period of time is just fundamentally not true. And I think here in the US, I mean, think about what really has happened post-crisis, and that obviously dropped rates significantly during in the post-financial crisis era, to a point where the Fed started to raise rates again. But it was in certainly in a historical context, based upon I'm sure that the data that you saw from the Bank of England, it was still incredibly low by historical standards. Where we peaked out. And then there was that just sort of natural pressure, wasn't it? That every time that there was a sort of rate rise, there was a rumble in the bond market, and it was clear it was going to be difficult to raise rates to quote unquote normal levels. And then obviously, lo and behold, we're in a situation where the next crisis comes along and we've got rates back at zero. So I think the key challenge for governments and for markets is that there's just too much debt in the world. There's too much sovereign debt, there's too much corporate debt, too much personal debt. And from that perspective, low interest rates is the one policy that probably suits policymakers on both sides of the aisle. So, certainly the median voter has been good amount of information on this, good amount of surveys done, but the median voter in the US at least has swung to the left. and is in favor of stimulus, in favor of those kind of policies. And I think when you're thinking about the problem that we have fundamentally, we have a problem where we have too much debt, we have too many debtors, but yet we have a lot of money that is controlled by savers. So how do you affect a transition from savers, a wealth transfer from savers to debtors? And really, from a policy perspective, what policymakers have found out is that the best way to do that is by printing money, because nobody really understands what you're doing, and everybody is kind of okay with it. And it clearly helps people who have debt. And in terms of savers, the benefit to savers is it typically results in higher asset prices, which savers tend to be the ones that, although they need income and the income side of the balance sheet is punished, the asset side rises. And so I think the effect of all of that is a weaker or devaluation of the currency, which is kind of where all this goes. But yeah, I mean, I think that it's now a lower for longer environment. It's very difficult to see how we get back to normal interest rates, whatever that may be.
Yeah, whatever that may be is it's a good way of saying it. I think you mentioned the currencies, and there's also this challenge. If the U.S. was to let's say go to if we think 3% is a normal natural rate of interest, and who knows what it is, the dollar would surge, and that causes it's almost on a relative basis. No one can really raise it that much. But the interesting thing too is that 10 years ago, everyone, and I was probably included, I said, look, all this money printing has got to lead to inflation. But the velocity of money, how many times a single dollar changes hands, keeps going down. And, I think that's been a big part of why we haven't seen inflation. Although, asset prices, you could argue that that's where the inflation happened.
Yeah, I think that that's certainly where inflation happened. It was one very obvious outbreak where we did get inflation. But if you think about also what happened in terms of the velocity, is that the Fed printed money after the financial crisis. A lot of that money went to the banks, and the banks kept the money. They didn't distribute it into the economy because they were scared, obviously, of lending money. And because it was a financial crisis, there was a lot of regulatory pressure on banks to do all sorts of things, which lending money, in other words, arguably the root cause of the crisis in the first place, they were not going to do again quickly. And so it was sort of that money never got into the economy in the way that I think people expected. And so you had a kind of austerity, if you will, from the banking sector in terms of putting that money back to work into the economy. And then from the government as well. I mean, the government was trying to cut costs in that period as well. But I don't think that's the same this time. It's definitely not the same. So this time you have a situation where the money printing is obviously much more severe, a serious multiple of what it was in 2008. And there seems to be broad consensus on both sides of the aisle to get as much stimulus into the economy as possible. And obviously we've seen that through the various different programs that have been enacted, but individual citizens being given money directly by the government for the first time. Small business loans, you name it, you've seen it. So I don't think we're going to have that issue this time around. I think we're not going to face any kind of austerity type measures, and this very well may be the environment that causes inflation.
Recently, so the TIPS bonds, right, the Treasury inflation protected bonds, which of course what they are, but I'll just say it for the audience. I thought it was quite fascinating that the last two auctions went off. I think the 10-year went off at a price of 106 and a negative 0.4 something. So just under 0.5% negative yield to maturity. And that the idea that we are issuing negative rate bonds, I think is quite telling for what the market thinks about where inflation is going, for sure.
Yeah. And of course, the Fed Fund futures as well, which is a guide to where Fed funds rates are going to be, obviously at some point in the future, went negative last month for the first time. And, I think you sort of had everybody from the Fed chairman at least sort of publicly saying that didn't think there'd be negative rates, but slowly but surely other members of the Fed start saying negative rates could be a policy that work here and could be the way to get a V-shaped recovery. And that's how these things start. So at least the market has some expectations that we will see negative rates here in the US for the first time sometime in the next 12 months.
Yeah, and I think also, there's always this talk about as the 60-40 portfolio. I hesitate to even bring it up because we could do 2 hours on this. But I do think one of the things that will happen at some point, and I'm not saying it could be 20 years from now, but a 30-year treasury at a 1-something yield has a duration of like 25, but back of the napkin. By the way, what that means is if interest rates went up 100 basis points tomorrow, in theory, it's not exactly how it happens, right? But those could go down, 24%, so 200 basis points, 48. I have no idea when it's going to happen, but just the symmetry of rates this low, it's the 60-40 portfolio, it worked because bonds went up this time in the crisis, and they've retraced. But at some point, I think it's going to be one of those surprise things that no one really is thinking about.
Yeah, I think we did some good research actually on that over the last year. And what we found actually is that the ideal portfolio from a risk return perspective was actually 60% stocks and 40% gold, and replacing bonds entirely. And so I'm obviously not suggesting to any listener that they should do that, but I just thought it was hugely instructive that from a pure mathematical perspective, the bonds actually didn't add any value to the portfolio, and that you can replace your entire bond portfolio with gold and get a better risk-adjusted return. But I think the moral of that story is that my take on it is that I do think the 60-40 portfolio has to be reimagined for the next 10 years. And I think this idea of, we've been in a falling interest rate environment for the last 10 years, 20 years, 30 years, we keep going back all the way to 1980. It's like, wait, rates they're still falling, and we could be talking about this, in terms of next year or year after, if they go to negative rates, they're still falling.
I know.
And at some point you say, what is the value of bonds in the portfolio? Because traditionally, obviously a key part of having bonds in the portfolio was obviously the lack of correlation, but the income that they produce. If they're no longer producing income, then obviously it's a big issue for investors. So I think people will look to try and change that allocation up. And I don't think they'll clearly won't replace bonds altogether, but I do think that we'll see some other asset classes, gold, other real assets, come into the mix in a way that we haven't seen in the past.
Yeah, and I know we don't have too much time, so I won't open up any really big topics. I will mention though that I don't know why I did it, but I went back and you can do sort of a Google search and narrow the dates. And I looked at some articles. I think it was right at the top of when you could buy that 30-year Treasury at 16%. And there were some people in the financial media who said this is the chance of a lifetime, right? Not only do you get the yield, but you get the appreciation because falling rates, bonds go up. And there were other people who said, oh no, keep your money in cash because inflation could go to 25, 30% and you're going to lose everything. I mean, it's just, so in the moment, after the fact, and like anything in finance, right? After the fact, it's easy. But in the moment, people were actually like, no, don't buy 16% treasury bonds. Seems quite silly, right?
Yeah. I mean, again, it's always in the context of where it was. I don't know what particular period that you were looking at, but it was probably the late 70s when obviously we were ravaged by inflation, and Paul Volcker ultimately had to come in and kill inflation through massive increases in interest rates. But yeah, I mean, there would have been a very active argument at the time, which was to say, on the one hand, you buy a bond that has a very nice or high level of income, but the reason why it had a high level of income was because there was a high level of inflation in the economy. So
that's
that
right.
was also a risk that inflation would have gone higher. It's hindsight's always the best investment strategy. You can never go wrong.
So as I'm thinking, any chance you'll change X out to the the relegation, promotion, investment. So it's probably too many letters, right? Would that be? But
No,
I know
I think
yeah,
X out sums it up perfectly in terms of the you X out the losers. We got the ticker code as X out. I think it's sort of we got that one right in terms of the naming of it, I think.
Yeah, and you would do more than just that. I'll put a link in the show notes, of course, to Graniteshares. You've got if anybody wants to check that out. I think there's a Forbes article that your folks were nice enough to send over that they did on you, so I'll put that in the notes. And I think I'm like you. I'm looking forward to sports maybe getting back. It's hopefully, although without fans, it's a little weird. But I suppose the good news is, at least with European football, soccer, as we say, you have the chanting, and that seems to at least some normalcy to it. So.
Yeah, they have. If you ever watched a game without fans, it's incredibly weird. So we have this phenomenon in Europe already due to the unfortunate legacy of hooliganism. And so every now and again, a country, it's normally at the international level, but a game between two countries gets played, I should say, in a closed doors environment, which is without fans. And that's because there's been so many problems with hooliganism and rioting. And so if you ever watch one of those games, it is very weird. So although it's definitely a step forward and clearly welcome, any kind of normalcy back, I think anybody watching it for the first time will think it very strange.
Well, Will, I've enjoyed having you on. This has been great. A good broad discussion. And every time I bring up a topic, I'm like, we could probably do 5 hours on this. So it's been great to have you on. I appreciate the time, and best of luck with everything.
Derek, been an absolute pleasure. Thank you so much for having me. I really enjoyed talking to you today, and good luck with everything.
Thanks, Will. For everyone else, we'll talk to you soon.